Let's get more on this, and we're joined by Suzanne Haddan, Managing Director of BFG Financial Services. Suzanne, welcome.
Good morning to both.
Yeah, so some fairly positive news there out of the United States, at least as far as jobs are concerned, more evidence. So I think we also saw some positive figures out of in Asia as well, China and Japan.
Well, things are looking good, and I think the Treasurer will be somewhat excited when we get to the time of our mid-year update, which I think he might do around 18th of December. With all this positive news, he's expecting some extra money in his kitty, and the question is, what will he do with it?
Indeed. So we can look at some positive signals there in Australia, I suppose mostly in terms of we have been having good signs when it comes to jobs growth and also in the business sector. Are those the two main drivers there?
They're the two main drivers. I think on the negative side, we're still not seeing wage growth. That means we're still not seeing strong consumer spending. And I think that's the warning that the Treasurer will be given from Parliamentary Budget Office and externally to proceed with caution if we still want a surplus in the early part of next decade. The rumours around fairly strongly, tax cuts. And I think they will seriously look at the tax cuts for company, particularly since the tax cuts are proceeding in the US. And they're looking at 30% down to 25%. They might also throw in tax cuts for us. And while we might like that, is that a good choice for the long-term position for our budget deficit?
Well, that's the question, isn't it?
Yeah.
But also, I mean, it's a bit ambiguous too in what both the Prime Minister and the Treasurer have said as to those personal income tax, just how they're delivered and perhaps when.
Yes, that is the question we'll all be pondering, but I think they'll be keen to put some extra money in our pockets. And far be it for me to say it be politically motivated, but if we've got an election next year, there's not many people around Australia who don't like a little bit of extra money in their pockets.
And is that a signal to that issue of stagnant wage growth, in that the government recognises that people aren't feeling any richer because their wages aren't rising, and perhaps other prices are, albeit not terribly much given how inflation is at the moment. So perhaps this is some way of encouraging people to spend.
Oh, you are absolutely correct. That is exactly what it is. If we're looking at wage growth really only barely keeping up with inflation, and people are nervous. They're nervous about the cost of electricity. They're nervous about the costs if interest rates go up for their mortgage. So you can understand them being a little reserved to spend. Maybe the tax refund increasing, lower taxes will stimulate that area, and that's what the Treasurer wants.
Now, we've also had the Parliamentary Budget Office having a look at how we're tracking for prospects around budget surplus in the vicinity of 2020, 2021, which is what we've been all hoping for. They're suggesting yes, but perhaps only fleeting because we've got a big issue around productivity as well.
Without productivity increases, their view is we're going to struggle with the surplus. And coupled with giving away some of our extra receipts of revenue for the government in this cycle will only make achieving a surplus in the proposed 2020, 2022 area more difficult. So they're concerned.
Now, earlier in the week, of course, we had the Reserve Bank making its decision on interest rates. No surprise for anyone, really, that they remain on hold. How long have they been on hold for now? It's
16 months, quite a while. It's almost becoming a bit passé, isn't it?
Well, and the outlook, we can't see any change. Well, can you see any change in the near future?
No, the strong consensus view is that the interest rates will remain low, maybe till end of 2018 calendar year. And of course that throws up concerns and positives. Positives for debt, the borrowers, negatives for investors.
And also those people relying on interest, I suppose. One sector of the community we may not have been looking at too closely who are being impacted by lower interest rates would be retirees.
Absolutely. The long-suffering group of the low interest rate are retirees. With their term deposits, they've been getting lucky if they get a 3% return. Most of the interest rates are around 2.5%. And it's all very well for people to say, well, you can get higher interest rates or higher returns in shares and property. You need to have money in secure area. You've got to say, why did you put money in term deposits in the first place? Did you think you were going to make the family fortune? I don't think so. It would be for security and liquidity. So those reasons haven't changed. And my concern is people who panic because the returns are so low and want to move up the risk curve, they could be moving into shares and property at the worst time. So if you're considering that, do it slowly. Do it maybe a little bit each month if you decide that. The other thing is the government, we have had legislation passed in the Senate, back to the lower house for the final sign-off, and it's called downsizer contributions to super. And that's something for the retirees, for the over 65s. Over the years, I've observed that we've almost guilted them into leaving their family homes and freeing it up for the young families. Now the government's giving a carrot, because from 1st of July 18, they're saying, you sell your family home if you meet the rules, over 65, owned it for 10 years, you could put up to $300,000 into superannuation, commence your tax-free pension to help your income. And that doesn't matter if you're working, doesn't matter if you're 90. So I think that's a really exciting initiative.
Well, we'll have to leave it there, but definitely food for thought. Susan Haddan, wonderful to have you with us. Thank you so much.
Thanks again.